Hi everyone, my name is Amber and this is Smart Real Estate Investment Analysis. When we buy an investment property, it is only for two reasons and two reasons alone. One, either we are looking to get capital growth in it, either organically or by manufacturing it, or we are buying the cash flow that that property can generate. I have no idea why people go and pick up properties that are never going to generate income for them or always going to be negatively geared and so on. But before you do, that's how you figure out whether or not a property is worth buying in or investing in and so on. So I actually created this because as a developer, when I present my development to a prospective buyer who is willing to buy, who is looking to buy a unit into my development, I have to do these analysis to be able to present to them and show them that, look, this is what the property will look like, or that's what it will be rented at, that's what the capital growth is going to be, so that they can see that this is a good investment. So whilst I was creating it for my own purposes, I figured that every investor must use this because it shows them whether or not a property is worth investing into based on certain assumptions that almost everybody knows before they're actually buying the property. So you can put in your details, your address and so on. So put in the purchase price. So let's say you were going to buy the property for $850,000. If you come in and put in your currency symbol, this will change the symbol for the entire sheet. So if you put a pound, it'll become pound. If you put a euro symbol, all values will be shown in euro. So you can put in your currency symbol everywhere. So you can put in an year of purchase. So let's say 2020, whoops. And then I know the size of the in square meters. So let's say it's going to be 704 square meters. And the rentable or the leasable area in that. So now this applies to commercial property. So if it is not applicable to you, you don't really have to worry about it. But let's say the leasable area is a 3-bedroom townhouse and it's 150 square meters, so that I can get some extra metrics or extra square meter rates or square feet rate if I'm after. So because we are from Australia, we got stamp duty. So in here, I can put in 5.5% as my stamp duty. My legals, I know it's going to be about $12.50 when I settle on it. And when I go and get the interest, so right now it's pretty good. So I can just put in 4, for example, just a round number, and I should be able to borrow about 80% of that. And my loan tenure, this is your loan tenure that calculates the number of years you will have that mortgage for. Now you can refinance later on, and that's not within the scope of this. But if you put in, it's a 30-year loan because your interest calculations will be calculated based on that. So I can put in a 30-year loan, and if there is an interest-free period, for example, let's say my first 3 years, and not interest-free, but interest only. Sorry, this is an interest only, not interest-free. It's never interest-free. So if I put in 3, then what it does, it does not include the principal and interest payments for the first 3 months. So let's just put that as 3 for the time being. So and when I've got it, because it's an investment property, I am going to rent it out. I want this property to make some money for me. So I can either put in a weekly rent or monthly rent. In my scenario, I'm just going to put in, let's say, $525 a week. I'll leave the month rent empty because it automatically does that for me. Next thing I have is expected rental growth. So if I'm going to rent it out, what sort of rent, what growth in the rent can I expect for it? So I'll just put that in as 3%. And annual rent increase, what am I going to increase the rent by? So let's say you charge $500, but next year you're going to be charging about $525 or whatever. It could be 10%, 2%. So whatever that is, even if it's a small amount, you need to put that in to be able to assume to be able to get some values out of it. So then we've got average capital growth rate per annum. So in this area, it has been about 5%. and expected sale in the year, which basically tells me when do I plan on selling this. So let's say I'm going to sell this after 15. So the maximum that you can go in this model is about 30, because in about 30 years time you eventually end up selling it. So if you put 30, if you put 15 here, it goes up to 15. I can put 30, and this whole calculation will happen and go for 30 years. So then we've got cap rate. If there's going to be a capitalization rate when I sell it, so this applies in the commercial property. So, but you need to put something in there. Even a residential property would have a cap rate. They may or may not apply in your market, but there's always a cap rate. So whatever the rental yield you are getting from your property is usually your cap rate. And so let's say if I put 3.5% as my cap rate, and I see expected sale value in the future. If you know this number, so let's say you know that I'll sell it in 4 years when my $850,000 property is 1.1 million. That's when I sell it. So if you know that figure in your mind, then you put that number in. So if I put in 1.1, that means I know that in 15 years time. So right now it's 30, so I'll just change that to 15 again. And I know that after 15 years, I'll definitely be able to sell it for, let's say, 1.5 mil. So if I know this value, I'll put that in. Otherwise, I'll leave that blank. So I don't know this value at this stage, so I'll leave it blank for the time being. And then alternative rate of return, or your discount rate. Now, let's say you're making an investment in here. You'll be borrowing, if you look at the amount, your total deposit and your down payment, that means $170,000 you're going to invest into this property. So if you were to put that $170,000 elsewhere, let's say in a bank, in a fixed deposit, or if you're a savvy investor, you would put that into another development project, for example. So whatever that alternative rate of return or an opportunity cost of that money that you've got, you put that in here. So if you've got no other opportunity cost, and all your only other outlet is that you'll be putting the money in the bank in a savings account or an online saver or something, that probably gives you maybe 2%. And right now, even that's a little bit difficult. So if that is your alternative discount rate, that is what you should put in there. But if you're putting in developments and you can expect to make 20% return per annum, put 20%. So that way, so that you can compare this development against another opportunity to see which one's better. And that is why we need to put in. And basically, those are the details that you need to come up with. Everything else happens here automatically. Now, if you want, you can put in all the costs for accounting. So let's say you have an accountant, and every year you've got to be able to go to an accountant. They do your tax returns, so they charge you $1,100 for it, for example. So you put that $1,100 over there, and you have an escalation rate where you know that this year my accountant's charging me $1,100, but he increases his prices every year, and this could be a 5% increase or whatever. So that's an escalation rate, and if you put that in there, it'll automatically do the calculation for you. And then you've got advertising, council rates, insurance that you would pay, legals on closing costs. Now, closing costs only happen once, so you don't have to allow these costs for every year. So every time I put an X over here, that means those costs will only get allocated for that 1 year. Now, you could hire a real estate agent to manage the property manager who can manage the property for you. So you put in a percentage that whatever rent is coming in, they're going to be charging me 6% of it. So that's their fee for the year. So you can put that in over here, and that actually gets extrapolated. Now, this is not month, this is every year. And that's why these numbers are a little bit different. So miscellaneous, let's put 250. Owners corporation, which is a body corporate or a management body that manages the whole building, for example, and they charge you, let's say, $800, for example. If they don't, you don't really have to put anything in there. If there's nothing, you put nothing. You can put other expenses, and you do some repair and maintenance every year. I don't know, maybe about an allowance for $600, and you have to pay your utilities every year, $850. So as you put all these details, they start. This model starts doing its own calculations. So let's say. Let's look at all of these things. So we've got other income. So that means apart from this, your property was able to make some other sort of income. So every blue cell is an input cell. So you can come in and see that, for 2027, I expect to lease this to somebody else for a few months in a year. That'll give me an extra 10 grand. So you can come in and add that value in here. Now, this is vacancy and credit allowance, which I forgot, and I jumped to the expenses. So this is always going to be here because what it does is it's not necessarily that your property is going to be tenanted 12 months a year. There will be periods where you're looking for a tenant, which is called credit allowance, and there could be a period where it's already on the market, but it's not no one's actually leasing it. So you allow for that percentage over here to be able to get your gross income and so on. If you do make capital improvements, you have to come in and put in manually for that year, and then it does all the interest calculations for you. Now this is all manual section where your depreciation for the year, depreciation and capital addition and amortization and closing costs that you can put in there. And if your property does make extra interest, or if you make that money, you'll put that in here. Now, if you wanna update this and select different finance options, I got your back because I created a full sheet which has all the finance options here. So your loan amount is that. You have an annual interest rate of 4%. The term of the loan is about 30 years. And your payment frequency, you can come in and select. It's going to be bi-monthly, monthly, semi-annual, all sorts of options. So let's say it's going to be semi-monthly, and your compound period is going to be annual, bi-weekly, weekly, whatever you want to put that in. You can select that. So I'm going to leave that at monthly. I'll leave that semi-monthly, let's say, because I've selected semi-monthly there. And your payment time is going to be end of the period or the beginning of the period. I prefer end of the period, and whether or not you want this thing to be rounded. So that is all you need to do. But if any time during that period you see a date, now this is semi-monthly, and that's why you see the dates have been broken down to semi-monthly. If I was to change that to monthly over here, all these dates will change to monthly over here. And now I know that, this is, the month is actually jumping up, it actually jumps up by a month. Now I know that on the third month this year, I want to make an extra 10 grand payment towards my loan. So if I come in and put in that value for 10,000 against my loan, you give it a few seconds, it does its calculations, because they're quite extensive calculations, and because they are coded and happen in the cloud, they take slightly a few seconds longer, especially for complicated calculations. So I can put that in 10,000 over here and then come back to my main section right here. And as you can see, my extra payment section, it shows up my 10,000 that I've got, I've paid extra. So we've got our principal paid. As you can see, we're not paying any principal for the first 3 months because we selected the interest only was 3 months. And we've got our net operating income, we've got capital improvements. If there are any, we can add that over here. Now, what we want to look at is this taxable income or cash flow. Is it going to be positive or negative? So we know we buy this property, it's going to be cash flow negative up for the first 8 years. Only after that it's going to start putting money in your pocket. So if you've got any depreciation and details that you want to manually add, you can manually add them here. and you'll get your details. So here we get our capital growth and our sales proceed. And when you sell, there will be selling costs, let's say agent's commission, and you add 2%, for example. And it does all those calculations for you, and this will automatically get updated and give you details of what your it'll take care of the debt that's owed, the sales proceeds that come in, and the cash flow after the debt. So based on that, you will get your discounted cash flow, what the value of or what is the present value of all these cash flows that you are doing. That will be. Now there is a optional detailed training available in which I discuss all of these things. But if you wanted to understand how to make use of this, and if you already know what these things are, you can use this calculator to figure out what the return is. So this is your internal rate of return over a period of time, and your net present value, which all looks pretty good, and your profitability index. So there are all sorts of ratios available. So ratios and capital gains, you can use this to show to your investors if they are going to invest in the units that you've developed. You can use this to sell your development units to prospective investors or your end buyers, and you can use this to show it to the bank to show them, that there is a good yield in an investment property that you are planning on getting. So these are all sorts of different metrics available for you to look at and make decisions from. There are finance calculations in it that you can do, and they get updated in the smart real estate investment analysis. And there is a comparative analysis. And what that is that if I open the add-on, the smart RIA add-on, and there is comparative analysis. What is that? Let's say I've done similar kind of analysis for 5 different investment opportunities, and I've got 5 different files like these. All I have to do here is come and link all these files one by one. They will be your Google Sheet files that you are sitting on your Google Drive, and then you select them. When you click on this, it will pop open your Google Drive, and once you've selected all of them, you will see that they all get added here. So whatever the address is that you might have used, so these are just test files that I'm just showing that to you. So once you've got all of them set up, there'll be a link to each one of those files, and the values, the gross operating income from all of them, from all 5, the expenses from all 5, the net operating income before interest and taxes from all 5, the ones that you were analyzing. So as you can see, the number 4 and number 5 are exactly the same because I ended up connecting the same file. But you could have up to 5 different investment opportunities that you can then compare, and they might be different values though. But in the training I explain how you can actually compare them, because you've got your which property is going to end up paying more interest, or whatever the loan balance is going to be at the end of the development, or the annual debt service that you will need to make. And if you let's say you like property number 2, you give it a rating. So 1 to 5, you say, look, I'm more likely to get this. Or your best way of doing this is to figure out gross operating income. Okay, I'm going to give it a rating 1 here, or 1 being the lowest and 5 being the highest. So you look at all of these cash flows and see which ones are the best, and you give them a rating, and based on that rating, all of these different metrics get compared for all 5 of them, so you can pick the best investment opportunity that you have analyzed from all 4 of them by comparing them to each other, so that it just doesn't become a decision, oh, I like this because my friends live there, or somebody told me at the barbecue that, if you invest in this, it's going to be great. But you can actually compare them and see which ones are best. In the end, your total rating gets totaled up top, and it'll highlight the best option out of the 5 that you've selected. So I hope you like it. And there is also lead developer, there is 1 minute Feaso, there is smart feasibility calculator, and the smart real estate investment analysis. I wanted to have all these here. The reason is that it is important that they are you look at this as a full suite, because there is no kind of feasibility that's not covered under this suite. All the very best.